Recording stopped.
Mic check and screen share check, please.
Sound good?
Yes, sir, all good.
Okay.
All good.
All right.
Recording in progress.
Good evening, guys. Ken at Tortoise Capital. Small group check-in for Monday, 29 January 2024. Want to sort of transition our nightly agenda back to the the original intent. Now that we've got a few weeks under our belt, and what I want to cover, just by way of introduction, is this is the agenda I'd like you to follow, unless you have another way to cover, like your 5 minutes for your check-in. Like if you got a different package and want to get right to it, that's fine too. But these are the things that I'd like to get to. And you can omit any of them that don't necessarily pertain. Like if there hasn't been a change, I would still think, hey, what I'm working on is this. Specifically, what I worked on this week is that. Here's the progress that I've made since last meeting and what I'm planning to do in the week ahead. And here's how I'm going to do it. And really kind of concentrate on the resources you still need and how you think it's going and how you're going to commit to it. And then somewhere in here is, let's see, I guess what I should have had is, resources you still need. And I'm going to say this is also make that help. Any help or assistance or questions, I'm going to add that to that agenda. I think that's the one. And if you take 5 minutes for your check-in and setup, and then that gives us 5 minutes each for my commentary or a quick Q&A or whatever. That gives us 6 players times 10. That gets us right at 60 minutes, and I want to start trying to enforce that a little bit better. I've been the violator of that because I've been getting us started here. So as I'm going to just announce what work I've done this week, and I'd like to hear from all of you today. So just be ready to share your screen with anything you want to show, and we'll get on with it. Now, what I want to just note is that in terms of resources, I've made a bunch of new additions to the course in the OWL group area. So if you go on your screen, modules and lessons, and the first module is like introduction, concept of the operation. There's a lesson in there called downloadable resources. And when you click on that, this is where I'm going to always be adding like any common files for you guys to be having access to. Below that is another module called, the Cohort 1 weekly sessions. Right now that has 3 different recordings from the last 3 weeks in there. And that's obviously where each week I'm going to publish the session recordings. It'll be under that session recording. So what I added to the resource list this week was 13 characteristics of a successful trader. This comes from the forex.com, and it does a pretty nice job of just laying out skills. This one from Hill and Griff at Ableway, that is their notes on their Cornell note sheets for the 37 strategies and coaching portion of the foundations course. And I thought they did a really nice job laying out a bunch of different mental models and icons that I think may be helpful to you. This one, the Foundations Boot Camp on Rizuku, that one is the detailed notes sheets for the Foundations course, the 50 or 70 lessons that are in there. Each lesson is rendered into a single page, and you're going to find a lot of really good reference material. This is a digital copy of of book number 1, the foundational book. This one, the Advanced Hybrid Trading Flashcards print, that PDF is about, I don't know, 50 or 60 flashcards that we put together from the advanced hybrid trading that we did through COVID, and which really continues into today. So there's an awful lot of good artwork and icons and concept sketches from the earliest days that are all in there. Now this is one that's going to become book number 2. That's the Hybrid Trading Job Book. And what that one does is there's about 8 pages of densely packed individual skills and concepts, and then it lays out my description of it, of what I mean by the totem animal of the badger. What does it mean to me? Or what is the max pain range compression? And then over on the right-hand side of that, you'll notice that there is a scale to self-score that goes from the score of 0 all the way to 7. That little layout is the rough draft of book number 2 that I'm working on. Score 0 is if you've never heard of it before. 7 would be if you were comfortable enough with that concept that not only do you know it and use it, but you could teach it to others so that they could use it. And so that little book lays out what we mean by each of those levels of confidence, and it's kind of like you're building proficiency as you climb the hill towards mastery. And what it does is, I think, lay out a really nice approach to compartmentalizing all of the concepts that we're working on: indicators, processes, models, systems, artifact, things like that. So I make those available to you for your reference library and as the basis of things that you might want to talk about in the resource here. Hey, I need some help on this one. I don't understand what you mean by that. Or I need, it could be something where I say, go to that flashcard and we'll have a discussion about that. So I want you to use these as shortcuts to building your own set of flashcards and reference libraries. So that's what I wanted to say. And those are all downloadable in that lesson. Any questions on that? All right, hearing none, I'm ready to take nominations from the field for who would like to go first. If you can just raise your hand and share your screen. And I don't know if Chi Wing, this is your first night here, Chi Wing Chong? Yeah, if you could give us a like a 1-minute introduction, so that folks can know who you are. Yeah, and I took a quick look at your slides. They look really good. So the other guys will give a 1-minute background when it's their turn to talk. So taking nominations from the floor, who'd like to go first?
I can go.
Satya, go ahead. Do you have a screen to share?
No, I do not have screen to share, but as you know that I am posting my chart, I am trading 3-minute charts mainly. I'm focusing on 2 stocks right now, AMD and EWW. And
Yeah.
I have a quick question from our last discussion
Okay.
from the MACD, and I started paying more attention to it, and I'm noticing that its zero line keep moving up and down. And what I not figure it out, it's because of the mathematical calculations between 30 and 10 EMA. So it is purely because of that, or could we make some meaningful uh, like outcome out of it?
The zero line for which indicator?
MACD.
All right. Give me the question again. I'm not sure I understood.
Uh, when we click on like different charts, this zero line keep going up and down. It's not staying
The
stable at
zero
one
line.
location. Uh, like
The zero line in the MACD?
yes. If you have access to the charts now, if you can go to any chart and you keep going up and down, like if you keep going like different charts, it goes up and down. Like other indicators, it stays stable, the zero line.
So like, okay, so here's one on, let's just
Yeah,
look at the SPY.
yeah.
Okay, and I've got it on the 30-minute chart.
Yeah,
So
could you go on
you want
30
me to,
minute or 3 minute?
yeah, so I've got the 30-minute chart on here. So you're asking about this one here, the zero line
Yes,
on the
yes, this one.
MACD?
Yeah. Can you go
Okay,
to the
so
another chart now?
yeah, okay, so what I'm noticing is that the zero line is here
Yeah.
and the Red River in on
Or
MACD, and this is in SPY, it's located about 0.7. It's just been in the summer and now it's in the fall, and it's fairly close to the zero line, but just above it and declining. Fair enough?
yes.
So now if I go to the daily chart, the reading is at 8.41,
Yeah.
and it's also in the summer or in the fall, and the zero line is
It's
much
moved a
further
little
away.
bit
And
up,
so,
yeah.
yeah, so the way to understand that is that in each separate time frame that you're at, the market has different dynamics. All right, so if I had just those three to compare, 3-minute, 30-minute, and daily, you could very easily have a daily range that was a tiny little compressed doji, right? And you might have had on the daily chart something that went up strong, then has rolled over, and it's now in a doji. Uh, the the zero line is related to the performance of the 10 period and the 30 period regression lines, I believe. Let's take a quick look at
It's
that.
the EMAs, exponential moving averages.
Yeah. But the source data for that is the moving regression line 10.
Yeah.
Okay. And it's a, let's see, where is it? It's an exponential moving average.
Yeah.
So what it's using is the 10 period regression line, which we treat as the price, right? So the moving 10 period regression line takes the last 10 closes. Let's say it looks like that. So that's 10. And then what it does is it draws the perfect regression line, and then the last little dot right there is where the dot appears. So if I was right here is where that dot draws. It's a little bit below that doji. Okay. So, and then when it goes forward one bar, it drops off the last one, adds a new one, recalculates the regression line, draws the dot, and then what this moving regression line does is represents a smoothed price, so you can not worry about the width of the price bar. So it's a smooth price. So it's using, so the MACD is using that, those 10 last price points, and then doing a exponential moving average of the last 10 and the last 30 bars. Okay. And from that, it computes the zero line based on whether or not those two moving averages are moving up together, or one is up and one is down, or they're both moving down together. So it calculates the signal line. It calculates this blue signal line based on the relationship between those two exponential moving averages. If they're both going down together and have been for a while, like they are here, it'll be under the zero line. And you can see that movement here, both of those simple moving averages would be declining, and the calculation puts it below the zero line. So when it draws it to relative scale, and the scale that it's relative to is the time frame that's reflected in here. So here's a case where SPY has been on an absolute tear going to the upside on the daily chart. But if you were to look on the, let me look on so price has been moving up very strong over the last 30 days. So this black box right here represents the last 30 days. And the RL10 has generally been up. So it's strongly above the zero line. But if I go to the, I don't know, 10-minute bar, or here's one where for most of the last 30 bars, or the last 30 bars would be about the last 3 days. It's been mostly sideways. All right, so that's about 1, 2, 3. That's about 30 bars right there. So the 30-period moving average of the RL10 and the 10-period are mostly sideways. And so they're very close to the zero line, because it wouldn't take much negative price action for this whole structure to start going to the downside. So the time period that you're looking at defines where the zero line is and what the seasonality is just for that time frame. So what I actually want to find is if I know what my style of trading is, like if I want to buy strength on a dip, one of the ways that I can do that is simply on a daily chart, or we'll just use the triple screen system as an example. On my longer term trend, I want to see something that's very strong on a weekly basis. So the weekly bars are just keeping an upward movement. And then when I look at the daily, what I want to see is a temporary pullback That should be red. I want to see a temporary pullback of some magnitude because that looks like a dip. And then I think if it goes far enough, that's going to alert somebody that says, this really good product that's beaten all the other indexes, that's going up like crazy, so it's in the green. Hey, it's on sale right now. And then what I might do is then go down to a 30-minute chart. And in the 30-minute chart, what may have happened yesterday, maybe on the 30-minute chart, I'm just looking at 2 days. And yesterday it gapped down and sold off, and then started making, in the second 2/3 of the day, made a nice, really strong move and closed higher than it opened and is now back on par right here. And then today, maybe that thing gaps up a little bit and is starting to go. So if I saw that formation, I would love to buy that, because on the 30-minute, that thing is going to look really, really strong. And then the MACD zero line on this is going to be here, and the red river and the signal line are going to be well above it, and that thing's going to look like that. Real strong on 30 minutes. That's the shorter term momentum strength that's working. And if I go back to the middle time frame, there's still, this thing has only gone that far. There's still room for that newfound strength on the shorter term to go back to whatever the previous fair value was. So there's still, this is my opportunity. I'm still buying it on sale, but people are rushing in to buy it. I'm going along with the short-term momentum. And all of the long-term buyers and holders are saying, hey, that's awesome. We are not tempted to sell this thing at all, because on our weekly time frame, that just looks like a little noise. It was just a blip. There's no fundamental change to this. So the goodness of the long-term relative strength provides an implied basis of support that there's nobody in the long term that is panicking and selling, because this was an orderly pullback. But the pullback was enough to entice some short-term traders to come in and buy it on sale. Now, this short-term momentum may be strong enough that now people who were selling it over here said, oh, I made a mistake, or they were short sellers and they just get out of the short position, meaning that only the buyers are in, and maybe the short-term sellers or traders, and they're going to come in and start buying. So that's a long way around to just say that when you have 3 different time frames, you could have 3 different seasons. This could be a strong summer, and this one could be a harsh winter just becoming spring. And then the short term may have been spring and is now above the zero line and now is a strong summer. That's what I would love to find. Summer, spring, summer. That's a really nice combination. And then I could use the MACD histogram shape and the location just to get a quick glance at what's going on. So when I'm on my TC 2000, in one of the layouts that I like to use, where were we at here? Yeah. So what I have on this one is I have monthly spring and monthly summer in my first 2 columns. So if I sort of this, what I would really like to see is monthly summer. That's this green column right here. I'm interested on the long-term time frames of symbols that are already really strong or just becoming strong. If it's monthly in the spring, then that means his long-term price would look like this, and then has just started to roll up. And I think, here's my risk box, and now maybe I can trade that thing all the way back to the previous peak. So all these little guys over here, things like Disney, emerging markets, Ethereum, Intel, IP, real estate, clean energy, treasuries, Cliff, these guys are all in this kind of condition on the long term. They've had a harsh winter, they've started in the spring, and there's a long-term growth opportunity just to get back to fair value. So those are the two seasons that I'm interested in on, so let me just, Intel's one that I'm interested in. Let's see if I can find a monthly chart. So there's Intel, just like, and all I'm showing is the regression lines because I don't need to see the bars. But here's where this thing was at a double top, and then it just collapsed below the belly of the dragon, and it fell through the RL 270. Now, Intel's a great American company. The RL 270 on a monthly, right, that's 20 years of trends. This thing is hardly even wobbled a little bit, but the price came all the way down to here when it was down here, this was a harsh winter. That price was down around 25 or 22. But somewhere around in here, when the monthly crossed its little dragon, here's the zero line on a monthly, it has just now gotten back to the zero line on a monthly basis. It's backed by the RL 270, and there's still a chance for it to get back to 65. It's at 45 right now. So it sold off from 65 to 25, is halfway back at 45, and is now at 65. And that's happened since the year 2020. So in terms of life cycle, long term, I think there's real value for Intel to get back to where it was. Not even controversial. They're fixing their business. It's coming, chip manufacturing is coming back to the U.S. We're going to drop $60 billion of federal money into domestic chip manufacturing. Intel is going to get some of that. They're going to be fine. The good news is that Intel is only in the spring on the monthly, and on the weekly, or I'm sorry, on the daily, he's in the winter. Oh, what's that? So just remember where the zero line is. We just got back to the zero line on the monthly. When I go to the daily, oh, snap. That move that Intel made to go from 25 to 45, that's this move. Here it was bottoming out around 25, triple bottom, and now a COTA 2. There's a COTA 2 entry on the way up as of June 2023. That's 9 months ago. It's gone from gone from 30 to 40. That's a 50% gain in Intel in the last 9 months. But lately, Intel did this. It ran up to 52 and has now come down and closed at 43. So when I look at just at this time frame, instead of, remember on the monthly, it had just gotten up to the zero line. Here, it's already been through a summer, fall, shorter summer, fall, and is now just entered winter. This is really dangerous. It's gone in the last 5 days from 48 to 43. That's minus $5 on a $50 stock. It's 10% off from where it was just recently. That's a warning sign. That presents an entirely different set of facts and market conditions if you're a short-term trader. If I'm a long-term trader, that doesn't bother me at all. In fact, as long as it comes back, if it came back 36 and it held support around 34, if this thing comes all the way back here and then starts to go again, I'm going to buy that like a crazy man, because this will be part of a pot of two rising lows. And there's a lot of buying pressure in it. So if it starts to recover here, and then the short term, say the 30-minute bars, gives me a summer, I'm ready to start buying it again. So the short answer to your question is that the zero line is always going to be reflective of the time frame that you're specifically looking at for trading on that screen. And they can be very different based on the time frames. And that's part of the whole triple screen concept, or the hybrid trading concept, in which things from the different time frames can give you insights about what's going on. All right, does that answer your question?
Yeah, thank you.
Probably overkill.
Explanations. Yeah.
Okay. So I felt like the extended discussion was probably helpful for the guys that are also looking at swing trades and ways to start using some of the different indicators and whatnot.
Yeah, thank you for that. Great insight.
Okay. Try to get back to my screen is slow here. All right, who's got one? Who's next?
I can go next, if it's okay.
Who was that? Was that Juan Carlos?
Yes.
Okay, go ahead.
All right. Can I share my screen?
Yeah, go ahead.
Share where? Share screen.
You should be able to share. Yeah.
Okay. Participant. You cannot start screen share while other participant is sharing.
Sorry.
Got it. Share
Fire
screen.
when ready.
Screen number 1. Yeah. All right. So this is my main screen. So pretty much I worked all week still on market classification. I built the indicators, and I'm starting to compare the indicators with an equity line of a strategy that I've been running. The back test, not the real results yet. I need to compile that data. So what I was able to build was the risk C, and I added a line through it, which is the division that we talked about of the moving average 30 and 10 on a C score. So if it's red, we're risk off. If it's green, it's risk on. And then the volatility. Not sure how I'm going to use it. I'm still comparing to the results of the equity line, but I'm starting to look at it in that perspective. I started playing, and I guess that's the question, one of the questions I have, which I started playing with this indicator, which is the width of the NDX, to identify sideways markets.
The width, let me say it again, the width of the ND of the 10 period?
Yes. So the low and the high. And then I got a C score out of it. And I started noticing that under 0, I'm starting to see sideways markets. So here and then here, again, sideways markets. So I'm not sure if you played with this or if it makes even sense to try to identify sideways markets like this.
Where I think, let me just jump in and say, this is close to the idea that I use for looking at the volatility of markets, not so much sideways, but the volatility. It turns out that on the daily charts, it's actually almost the same thing. That when you get sideways markets consistently, the height of the box begins to shrink because it's not directional. So you actually get declining volatility equals sideways market, right? And what I actually do on that is I compare the width of the current 5-day NDX to the width of the last 30 sets of 5-day windows to determine if this 5-day window is statistically small or large compared to those last 30 5-day periods. That's so you're basically recreating or redoing the sniper box for volatility. Now, what look back period are you doing that? Did you say 10 period?
This is on a 10 period, yeah. And I'm using the average of the last 30 for the C-score.
So where you have that right there, I want you to notice that the indicator just went down to that lower red spike, below your little channel there, below minus 0.32.
Yep.
No, go left, about, right there. Now, what I want you to notice is that right in there that the previous 10 days was really, really narrow. It was really sideways. And then when it started to reverse higher, starting to go up. When that started to reverse higher, that gave you the market was becoming directional. And if you follow price, it led you right into the next 30 days of significant outperformance. So that's actually pretty good, right? So you get that whole move. Now, where I want you to notice is, now if you go to the right about another 30 days, the biggest, steepest downward move. Now, right in there, you're noticing 3 lower lows. It looks like 3 mountains or 3 caverns, each low getting lower and lower. And then there's a sharp reversal for the last 40 to 50 days where the market goes from 4,000 to 5,000. That's a 20% move. Now, notice that your indicator never really gave you a good signal for that. So what this signal is going to be very good for is finding periods of true sideways followed by the beginnings of a long grinding move. So, but what it protects you from is a large 10-day range to the downside, which then reverses very quickly. That's actually a good thing for long-term buy and holding, because you'd like to stay away from the really volatile. What you'd like to get is a period of quiet followed by the beginnings of a long-term grinding upward move. That's what you really want. So I think in terms of market classification, you're looking at 4 or 5 different indicators. This is one that's going to give you very specific ideas about when to get in. It's really going to find sideways quiet, and then you can see from price where it's really starting to go. Like if you go to May 2023, I think that's right in there. those next that middle of May, that indicator gets really quiet and low, and then starts to increase. And now you get that big spike of volatility starting right there.
Yep.
It gives you that spike of volatility. Now, all that increase in your indicator is showing is that the width of the 10-period box is getting wider. It doesn't tell you whether it's going up or going down, but you can tell from price if it's going up or going down. So it's not going to be a directional indicator. It's really just giving you, it's almost like the market breathing. Look at how regular that, it looks like a heartbeat or a breathing pattern. And what you really want to concentrate on is probably, I'm going to say when it gets to, like, can you draw a line on that at like minus 30?
Yes.
Yeah. Yeah, maybe even 35.
I thought I could annotate that. Minus 35 or 35?
Minus 35. Yeah, minus 0.35. So you put that, minus 30 right there. I would say that minus 30 looks like the lower threshold, that when it gets down near minus 30, and when it gets around minus 30 and then starts to reverse back up, you're going to notice in price a significant move is starting to happen.
Yes.
So what I want you to do is go back to that and start playing with that lower boundary, because what you want to be alerted on is abnormally sideways quiet. That's what we do with the sniper, but you could tune this to the kind of trading that you want to do, and this is a nice way for finding nice times to start stalking and quietly entering a sideways market that's beginning to wake up and go north. So I like what you're doing there. Now, what I would say is the more general guidance I'm going to give is when you start comparing some of these different indicators, they may be giving you information about different kinds of markets and different kinds of systems over different time frames. You're not trying to find the one single best one. I think what you're trying to find is an indicator that can alert you to the specific kind of market that you're looking for the specific kind of trading.
Correct.
So this is one where the width of the 10-period NDX almost acts like a Williams %R, when you look at the thing visually. And it looks like the Four Seasons of MACD. But you want to see a harsh decline in that indicator. That means that a harsh decline means it rapidly got quiet and sideways, which is a little counterintuitive. And then when it starts to get bigger, that just means that either buying or selling is beginning to happen, and then you want to follow that trend.
Cool.
Now it looks to me like it's pretty useful on the daily chart. The other thing that's useful that you're studying is that risk Z. And then what I would do is start comparing the lows. Yeah, go east on your go to the right. Yeah, and until it goes. Stop. Back up. Yeah, right at that threshold. Notice the risk Z got to an extreme reading. It went all that red and then became yellow in a long period of green.
Mm-hmm.
Notice that turned before the width of the NDX.
Oh,
Now,
yeah.
if you see that is a consistent relationship, and it looks to me that it is, yeah, it looks to me that it is. What that will tell you is you now have a way to do a two-step alert that the risk Z goes red when volatility is crazy.
Mm-hmm.
And then when it starts to get small, then the market is healing. And then you might expect to see an upward move after, and then that's where the NDX width would really be helpful. So you're actually not trying to see which one is better than the other. You're also trying to appreciate the relationship between those signals. And it looks to me like risk Z stays in its trend longer and it turns sooner than the NDX. And then stop right there. That tells you when the risk Z starts to roll over, that move was done. So if you take a look at that from the lowest point of yellow, when red went to yellow, go back about 30 days. So from there, no, go forward, stop. That's where it turned, and then now look ahead about 20 days to the peak of the green. No, back. Yeah, go back. Yeah, that's right there. Now, on a relative basis, that was a really good upward move. And when the risk Z rolls over, it tells you that volatility is leaving, that the traders are no longer interested, that it would be natural for a counter trend. That's exactly what happened. And so the risk Z gives you early warning in both directions. So as you're studying these different indicators of market classification, remember they're all part of the market mosaic.
Yes. Very cool.
So that's what I want to say about that. There's some interesting work inside that for you.
So to finish up quickly, then
Yep.
I did market classification. This is an equity line. The next one down is where we talk about the 200 moving average. So it's here, but it's really the red in the middle line is when it's bear, yellow sideways, and green bull market.
So the zero line in that one reflects what? The 200-day moving average?
Yes. If it's above or below. Okay. Yes, you're right. That is the average, the 200 moving average.
Yeah.
And I color it depending if it's above.
And so what does the bright blue line represent?
The CN is the C score of the distance between the
Understand.
and where prices.
Right. And what is the red line?
And the red one is volatility, is the average through the ATR.
ATR.
It's the C score on the ATR on the same amount of days. On 200. So volatility.
Yeah, I'm not sure that those two, they're oddly inversely correlated, and I'm not sure why. I got to think about that one for a while. Okay. We got to think some more on that. I'm not sure what that's telling me.
Yeah. Well, I'm looking at it. Yeah, as well. Then
what it's showing, here's what that will do. The blue line is going to tell you when you are pushing the limits of a normal swing move lately. So when that peaks, if you look north, every time that thing gets near a maximum and then starts to wobble, the run is done. And every time it's near the zero line, go back to the west. No,
here.
So like the January 23. Yeah, that's a good one right there. Yeah, where you were was a good one.
Right here.
Yeah.
Zero.
That is the pullback of price brought it, I guess, close. No, that's not what that's showing. All right, we got to think about that some more. Send me a note on how you're computing that.
Okay.
Because I'm not. What I like about this, it finds turning points. It finds turning points at it when it gets up around 2.0. The Z score of the stretch.
Mm-hmm.
Is that what that is? Okay.
It should be, but
so the positive Z. Yeah. Okay. Yeah, the positive Z score, the stretch away from the 200 when it gets up around 2 sigma shows you the end of a run. And when it gets -1 sigma, it's showing local minimums and possible turning points. You care more about the turning point when it's below -1 and then reverses up, and when it gets above 2 and rolls over to the right. Those look like turning points that are interesting.
Yeah.
Or really anything outside, a turning point outside of +1. And that's like the slope stat. If you think about the concept of the RL30 slope stat, when it makes a turn beyond ±1Z, it's always important. And that's what now see how good that one is right there. Now go down to the one that has the yellow line.
Yeah.
See those peaks? That's the one you want. The slope, the V4 of the slope of the 30-period regression line. Look how beautiful that yellow line is in that indicator. When it makes turns, those turning points are significant. So what I want you to do on that chart is take a screenshot and then draw a vertical yellow line from every turning point on that indicator and run it up to price. Yeah, make a vertical. So go to any turning point where it's outside one.
Outside one right here.
Yeah, right there. Yeah, right there. Click. And yeah, that's good.
And then a low one?
Yeah, that's good right there. Now, if you take those 2 lines that you just drew, the first one shows that the RL30 Z-score had declined below -1 and then reversed and started going up. And it kept going up. Now go to the east with your cursor to the next line. No, leave that line where it was. No, come back east.
No, it was
right there. Now just leave that line right there. And get rid of that line. You don't need that line.
This one?
Yeah, just leave it right there. Yeah, just get rid of those 2. So I just want to look at the 2. Now turn the drawing line off.
Oh, the cursor.
Now you see those two vertical lines between January and February 23. The first line, your RL30 slope score, the Z-score was at a local minimum below -1. Put your cursor on, like right there, on the first line where it touches the yellow line. Yeah. Nope. Keep going left. Left. Stop. No. Come back. East, 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 east.
To the right?
And stop right there. Now don't move your cursor.
Okay.
Look at what the yellow line does between those 2 lines. It goes from a local minimum below -1 to a positive Z-score of 2 in the course of about 5 weeks. Then look north at price. It went from 3,800 or 3,900 all the way up to 4,200, which was a 10% move in the S&P. So whenever the RL30 slope Z-score reverses, goes from negative to positive, that's always an interesting opportunity for a long side move to the upside. Look how good it was at predicting. So what I want you to do is, with just that indicator, take a screenshot and draw a vertical line from each from each turning point and go north and look at price. And if you look on my daily report, you're going to see exactly the same thing.
Yes.
And that is a really powerful market classification system for swing trading with daily charts. It's really powerful. It catches every significant turning point. Go back to August 2022.
August 22, right here. Oh, yeah.
Yeah. Now, see it now as you go. Now, as you go to the east, you're kind of like in July, and now look how that price is going straight up like a rocket ship. And now, and stop. Look at the slope score, the z-score of the slope on that RL30. It peaked at a point 2.5 sigma positive. That's an extraordinarily steep upward slope. But if you look up at the price, yeah, it made a nice move, but it doesn't feel like it got to an extreme. Because if you look back through time, you realize the two previous peaks, there were two higher peaks that it couldn't get to. So at that point, you're hoping, maybe this thing is really starting to go. But if you look down at the slope of the z-score, you realize this thing made a 2.5 sigma upward move. There's no short-term money left to buy it. And then what followed was it rolled over quick and then became a horrible bear market to get all the way to the low. So now go to October 2022. Now right down in there is the bottom pit of despair in the market, because it gave all of that back from 4,500 to 3,700. And now everybody's in despair, but you look down at the z-score and you realize, it stopped falling, it's starting to rise. And then you get a nice move from about 3,600 to 4,200. So my point is that RL30 z-score, the slope of the RL30 z-score is incredibly powerful. That's all I want to cover on that. And if that's not clear, then I want you to get back with me. Okay.
It's not clear. All right. Very cool. So, and the last one is the MACD. So
yeah,
I see the momentum and the changes.
Yeah, that's pretty close. Notice how that is actually pretty close to the slope of the z-score. It's a parallel. It's almost the same indicator.
All right.
If you take a look at if you look up at the next indicator up, see how the yellow line compares to the signal line of MACD. Now, it is damn near identical. So that's a case where you don't need both. What makes the MACD nice is the presence of the Red River, because it tells you where normal is over the last 30 days. So I don't know that it gives you much extra information, but it's damn near identical. So that's a case where I would pick one or the other and become very skilled at it.
Wow. Thank you.
And I think I prefer the z-score of the RL30, because that one is, I think it has less lag. But they're both really, really good.
Yeah, there's a lag there in the MACD, but it marks the bottoms.
Yeah, what makes the MACD interesting is the width of the Red River gives you some sense of volatility. So there is a little bit more information in there. But either one of them is a massive edge for swing trading, massive edge. Now, what you'll be interested in is that it's also fractal, that the slope of the z-score works not just for daily charts, but also for 30-minute charts and 3-day and 9-day charts. You're going to really like that indicator.
Meaning the z-score of the VIX, instead of using the VIX, using the trading symbol?
Yes.
Interesting.
Yeah. Right. Because it tracks price relentlessly. If you look at the slope of the RL30, the slope stat, then you're going to have a really powerful tool for any symbol, not just it works on every symbol. Now this one is Indu, so that's the Dow 30, right?
This is the INX. This
Or
is
is this
the
fixed?
SP 500. And
Yeah,
this
yeah.
is
Okay,
the
yeah.
VIX
So
index.
yeah, so that is the market right there. Yeah, that's and this thing also that same indicator works for individual system or individual targets and have their own like market classification as well.
Okay. All right. So following next week, I'm going to consolidate this, clean it up a little bit to make a component that can be reusable in the code.
Okay.
So this is it.
Sounds good to me.
Thank you. How do I stop sharing? Stop share. There.
Yeah. All right. Who's got one for us?
I'll go next.
Go ahead, Jeff.
Here, y'all seeing my screen? Nope, wrong thing.
Yep, I got you there.
Okay. Seeing my main goals?
Yep.
Okay, looks like I'm sharing my other screen here. Okay. We talked a little bit about my main goals before, but it's again just to create a system of systems. It includes 3 fully automated trading systems that are traded live by October 1st, 2024. And
Yeah,
also,
let me add something. Let me add something to the language on that. And I think you want to address the degree of correlation or diversification in that. Because it's implied.
under maybe portfolio composition or
Yeah,
actual,
because what you want are 3 systems. Like for instance,
oh, okay.
Hey, if I gave you 3 automatable swing systems that were positive expectancy over long periods, but they were all making money at the same time in the same kind of market and then all losing money at the same time.
Right.
Well, all I really have is one automated system.
Sure.
Right. So what you want is you want to consider diversification so that you get a blended, smoothed equity curve, because your evaluation of that is going to want to be related to to what the equity curve looks like when you start blending the returns of those 3 systems. So you've got to include in your goal an evaluation criteria that looks at the smoothness of your equity curve. Now, there's ways that we can diversify. I could have a swing system that only trades Europe, and a swing system that only trades the US, and a swing system that only trades emerging markets. If those 3 subsets of the global market are not correlated to each other, then the results of the same swing patterns should be different too.
Sure.
Because when one of them's making money on the long side, the market that's down is not getting swings. So I should be making money in the area where money's being made. So I could diversify in terms of target area, or I could diversify in terms of time frame of holding.
Right.
Like I could imagine 3 fully automated system, one that is a 1-month rebalancing, mechanical swing trade long only, and then intraday no overnight risk statistics trading in the futures. Those are 3 fully automated systems, and they are diversified through time. Or it could be, anyway, you see my point, is that what we really want to do is the reason to have 3 systems is so that at least one of them is always making money.
Right.
So no matter what kind of market conditions you have, one of those systems ought to be picking up the tradable moments. So we want to do some work on that language.
No, that's great. Thank you. I'll have a question about that when I get a little further down here about the types
Sure.
of systems. What did I
Mhm.
do? I obtained and completed the PRX crypto system course, and then
Yep.
I back tested and confirmed my results matched theirs on 2 of the systems that I looked at. Just wanted to make
Yep.
sure I was tracking.
Yep.
And I worked on the project plan. This next week, I'm going to finish the SWOT analysis.
Yep.
And my question, one of the questions down right below is if you have any recommendations for
Yep.
videos, things like that on development process, portfolio construction, et cetera. So,
Yeah, I do. The short answer on that one is that the most comprehensive process that I've ever seen was the Tharp Institute's blueprint for trading success that was, I believe, made available to the super traders. Can you remind me if you were a super trader?
I was
Yeah,
not.
oh, yeah, there was. Oh, yeah. So that one was like, I mean, painfully comprehensive. There's, yeah, don't want to speak ill. Then there's the one that Phil Wu and Griff Cooper put together in their course for me, which was the adaptive system development course. And
I
in
did
that
take
one,
that. I did do
okay,
that's the
so
cottage
that
challenge,
one,
right?
yeah. Well, what they did was the Kata challenge was the specific system that Griff was developing using the system development process that
Okay.
I like. So that was the working example of how to build a system. The end result of that comes up with a set of rules that are comprehensive. And so what I would use that as the example of the output that anybody's process for developing a system could come up with a set of rules that are that comprehensive, or their system development process is incomplete, right? So
Yes.
what you go through that systemic process to make sure you haven't missed anything, and you end up with a set of rules that are comprehensive and useful.
Is that something
So
that's out there, been published, or do they offer that, or
yeah,
anybody?
they have that. That should have been that was in the course
Okay.
in the Kata 2 challenges. Clarify with them, because if you were in that course, that should have been made clear.
It is probably in one of the last 3 classes, or I think, if I'm not mistaken. So I'll go
Yeah,
back.
so we got to, my point is the way that they teach that course to build out the components so that you get a really good set of rules at the end of this thing is good. Now, in addition to that, what I would say is if you look in the foundations course, and I think in the small coaching course, I may have put them in there. Are you in the foundations course also?
Yes, sir.
Okay, so for me, my system specification, what I consider to be an acceptable system definition, a specification, is the 6 rule sets for the mechanical swing systems. Because each one of those is based off a template, and it has all of the pieces that I demand of a mechanical system. When you have a system that's defined according to that template, then you have a system that can be coded and robotically traded. And everything is in there that you need and nothing that you don't need. It says, what is the market like that it has? What are the markets it looks to trade in? What are the setups? What are the filters? What are the entry criteria? What are the rules for adding positions? What are the rules for exiting? What are the rules for how many signals at one time I can take? What's the maximum span of control and that kind of stuff? Um, uh, what are some optional rules to consider if I want to add juice to it? So there's some, ways to expand the rule set are included in the definition. So when you take all of that together, that to me is an acceptable system definition.
Okay.
Right? And anybody that has a process that says, well, I'm going to teach you a process to develop a system. Okay, that's a recipe. It should be systematic and disciplined and comprehensive and complete. And I do that in order to come up with a rule set. The standard of evaluating the rule set is that it should be at least as good as the template that I have for those 6 mechanical systems. That for me is what I mean by a system. What I mean by a strategy is a little bit different. Like the 1-page info paper on max pain range compression. That gives a generic set of guidelines to apply, to follow, but it's not a system. It is a strategy. If you look at the intraday stuff I have in there on the frog, the slow frog, the quick frog, the leap frog, those are all systems because those are comprehensive rule sets. So that would be the other piece of coaching that I say on that. I think the process that Phil and Griff used in that course is a expedited version of the blueprint for trading success that was in the Super Trader, and not surprising because they were both super traders. But what I would say is, hey, that's a good process, but what does your rule set look like? So when I'm evaluating a rule set, I look to say, well, is it complete according to the template? Yeah, there was an entry in each section. Okay, now does it make sense? Does it logically follow through? Is there a connection between the kind of trading you want to do and the sort of, so that's where there's a how to assess the logic of a system rule set before I commit money to it. But then ultimately, the real test of it is, what does the histogram of results look like over time? How does it handle good times, bad times? And how robust, when we look at Chi Wing Chong's, we can see in a minute here. Well, that's sort of the standard. So here on. Yeah, I saw those 3 that you have there. Those I think are a good way to get started on the diversification of systems. Like Jim Carroll's long short volatility system
That was correlated. Yeah.
Is diversified from the PRX 30 because he's looking at daily performance of volatility itself, whereas the PRX 30 is looking at a specific financial instrument. And so his long short is geared towards equity market, whereas the PRX is looking at a Bitcoin. Okay, right. So the asset class and the time frame are giving you an implied diversification that seems like it would fit. And then the either Jeff or Luke breakout system, and especially Luke's, I would just say, hey, that's a 5-minute breakout from consolidation on a European index. That is direction neutral, right? So that's really uncorrelated from a swing system that is long only on Bitcoin. So as a start point, it looks clear to me that you have enough different systems to support diversification in the meta system, in the meta portfolio. Now we'll know if we just take, your standard would be, let me take a 2-year window and run all 3 systems separately through that, and then look at the equity curves individually and then blend it. If they really are as diversified as we want, then the system quality number of the combined equities equity curve could be better than the system quality numbers of the 3 separate equity curves, because system quality is improved when you have less volatility. So if they give me a blended diversified return, it should be smoother and up to the right, and so the SQN should be better. So that is we're already thinking about how to evaluate the claims that this is a good enough set of 3 diversified systems. So that looks good.
Cool, cool. Only other real question I had is looking at scaling them, paper trade and then prototype up and scale up, to full position. Is there a rule of thumb? I guess it depends maybe on your time frame and how many opportunities.
I would say for this project, I would require a minimum of 100 trades in a batch.
Okay.
You need 30 to be statistically significant. You want 100 so that you can get a good sense of it. I would actually, if they traded enough, and Luke and the PRX system should trade enough to
Right.
give you plenty. The long short volatility system with Jim doesn't have that same number of opportunities.
Right.
So that's the one that I think is most likely not to meet your criteria as a core holding. That looks like one that could be icing on the cake, but I would be less surprised if the PRX 30 and the PRX altcoin and Luke and Jeff, out of those 4, if you got Jeff and Luke and one of the PRX things, I think you'd probably have plenty of opportunities in all 3 systems that you could trust the statistics. As I recall, Jim Carroll's has challenges with the frequency of trading. So that's why, to me, it's more like icing and opportunistic than reliable every day. You go to the market, there's no volatility, so I got nothing. But then when it hits all of a sudden, and you get a lot of it. And then you go long periods of time without it. So I also think, your other note there on the SSC or breakout system that Juan Carlos is looking at from the swing trading on either daily or 30 minutes using that indicators could be cool. The 3D 90 sniper is going to look more like to get enough trades on that, you have to have probably 30 symbols in the basket in order to get enough of them in this going from winter to spring and emerging to be good. So you probably need a basket of 30 global ETFs to make sure that you have enough signals all the time. And if you take a look at like ETF 32, the components of ETF 32 is probably where I would start building those out. And that gives you an easy way to compare that against just the straight BMR system.
Okay.
So
Excellent.
more to follow on that.
Yeah, that's all I have
And,
for today.
okay, awesome. Chi Wang Chong, do you want to show your screen real quick? Not yet. Gotcha. Yep. Mhm. Yeah. Yep. Got it. Makes sense. Yeah, the R stat divided by 4 is almost like ATR divided by 3. That's in some cases, if depending what your chart platform is, if you can't get the R stat easily, you can usually use some fraction of the ATR as a method, and usually ATR divided by 2 or 3 or 4 is pretty close to that, and it's useful for the 30 minutes. Go ahead. Yeah, that looks like a manageable set of rules. Okay, and the next one, I think you had some stats on it. Mm-hmm. Let me go through that the way I go through it every time because this is a perfect example of how to evaluate it. So I look at the 278 over 40 trading days. That's November to December. So that's about 40 to 50. So that's 5 or 6 trades a day, manageable. Best is 6.7, worst is -1. So his histogram passes the first test. No trades worse than -1. Then I look at the second thing is that between -1 and +2, it has a normal looking distribution that is positive expectancy. That's good. And then he has some fat right tails. So he's getting some big boosts on the right-hand side. Not as many as I would like, but you can see there's a good number of them better than 2R. So everything looks good with the histogram. The rolling R average, what I want you to do is now that you've got that many, you need to do another control chart which shows the rolling 30 average. Because what happens is once you get past about 100, you're carrying the weight of all the early trades, and now see how the rolling R average, or the average R, I think, just gets into, it starts to get compressed. Now it says rolling R average, but I'm not sure you have a rolling R. Like if that is the expectancy of, maybe it is. Just double check your numbers. That should be only of the last 30 trade. That's what we want to see on that rolling R average, is the last 30. And maybe it does. But I don't think it does. But just check that. Yeah, so the cumulative R is, you have a nice cushion. It goes, when this thing is working, it works really well in the run up from 0 to 35. When it went through some trickiness in the end of early and middle December, the market started to slow down and the swing trades were not following through. But when this thing loses money, it's losing at a much slower rate than when it's gaining money when it's favorable. So what that says is it's pretty adaptive to market conditions. When the market is not good, it ain't bad. When the market is good, it's great. And that's what that cumulative R and performance charts are showing. Now, I am then going to go do a coin flip test, and I see that the win rate to loss rate is 0.47 to -0.53. So it's a coin flip that's slightly negative, but the payoff is 8 to 5. So that's where you get the positive expectancy from. So if I'm looking at this, what I want to do is try to figure out how I can just change the win rate by tinkering with, I think, probably the exit. There's probably some exit rule tweaking in here that has to do with when to carry it overnight. My sense is that there were a lot of adverse gaps in that November and December timeframe where you had maximum favorable excursion get. So an area to take a look at here is take a look at the performance of the overnight holdings and compare that to the overall performance of the system. Determine if the decision to hold overnight is adding drag to the performance or if it's adding value. My spider sense is that it's adding drag. If that's the case, then simply adding one rule to exit at close should improve the performance. So that would be a piece of examination to study. Does that make sense? Okay. Yeah, I agree. I agree with you on that one. Yeah. I find that the opening 30-minute bar is crazy enough that you often get chopped. And so just waiting 30 minutes. Now, what that gets you to is very close to the idea of the Quick Frog mechanical day trading system. And that's one of the reasons I like that one. Now, what I find is when I'm trading that frog style, I'm actually somewhere around the 15 to 20 minute. Sometimes I see moves starting that it feels good and off I go. So, but to me, the Quick Frog is the best trade-off for mechanical entries in the morning. And that's if you want to be the swing trader, in this kind of style. The only other choice you have if you want to go sooner than 30 minutes is you have to really be a 3-minute chart trader, and you have to make that. I think you have to find the big gappers and try to hook into that right away. That's the only ones that I would even trade in the first 30 minutes is things that had an extraordinarily large gap in either direction and trade those. And that's almost a separate system itself. So I would not try to contaminate this rule set with trading on 3-minute bars in the first 30 minutes. I think that's a separate system. Don't cross the wires. Don't cross the streams. So that's what I would say on that. All right, what else you got? Yeah. Yeah. Okay. Are you trying to fully automate the system, or are you using it as the automation as a guide? Oh, okay. Okay. Well, that's actually good because as you start refining the rules, you can start turning those into indicators and automated suggestions, and that allows you to expand your scope a little bit. Because you can trust the basic rule set, and then you can just add a little bit of discretion. I think you'd be all right. Hey, go back and remind me what the targets were on this one. Can you go? Yeah, which symbols are you trading? Okay, the hybrid swing symbols. Yeah, I think there's actually, you could probably cut that in half and improve your performance. Because I think I'm noticing there's ones in there that I don't even like anymore, or care, like CVS, and like Home Depot fell off. And so I would take a look at the frequency, of trading on those and try to pick, even smaller set of symbols that has most of the trades. I'm going to bet that you get about 80% of your trades on 20% of the symbols. So that it may be that we could refine that list even more to the genuinely good performers. So that's a secondary piece of research. The last piece I'll say is this. Do the statistics on what your average win plus 1 standard deviation is. Because if you find yourself intraday with an average win plus 1 standard deviation, that may cause us to put in a special profit preservation rule instead of giving back a full R-stat divided by 4. There may be some way to make some micro improvements there. Oh, yeah. I'm not sure they're reduced to 1/8 or to R8 after 1 R profit. We want to make sure that that's not too soon. In fact, if you just ran that without, okay, so that's the study is reducing to R. Yeah, that one should tell you something about whether or not you're premature or you should accelerate. And then you may end up testing that with not just 1 R, but find out what the average plus 1 standard deviation is and see how that compares to a 1 R win. It may be pretty close. You never know. Yeah, so if you look at that, if you take just the winning trades and do the standard deviation of just the winning trades, it should be 0.8. If it's like, it'd be perfect if the standard deviation was 0.19. But if you look at my spider sense is if you look over at the standard deviation overall, it's 0.9. It may be, your number may actually be accelerate at 1.2 or 1.3 R. That way you're not prematurely cutting off a trade that hasn't become overheated yet. So find out what the standard deviation of the average win is out of your winning population. As soon as you find that, let me know. And because I'm interested in that number. Yeah. All right. Let's see. Did we get Jonathan? Did you go, or did we get everybody?
I haven't yet. I can just do it real quick.
Yeah.
So I'm focusing intraday on the 3-minute chart, and I'm working on getting my my processes in place, and that kind of has 2 prongs. One is getting everything organized, getting clear what I need to be looking at in my charts, and making sure that I've got a clear routine for everything as I progress through the trading day. And the lesson that you gave me yesterday was terrific. That was a lot of what I actually needed to be working on this week. So taking that.
The other thing I want to just say, try this little tip.
Okay.
Is turn your candles into bars and turn off the color, because the bars are really fat and take up a lot of space. And when they're red and green, we're like raccoons looking at shiny things. And it's more information than you need. And if you make them bars, the same screen space can show triple the information. And when you make it thin black lines, it makes you look at the RL10 more. When you got big fat candles that are green and red, that makes you think that's what you should look at. So to simplify that, to simplify your dashboard.
Oh, I actually have done that. I have never traded with bars before. I always had the candles, so I'm adjusting to that, and it really does draw you RL10. Sometimes I actually forget to look at the price because
that's what we want. I've actually done that where instead of using the color black, I use the color light gray on the bars.
Really almost disappear.
I've actually turned them to the color of white so that you can't even see the price at all. And then you make your decisions based on the RL10. It gets to a peak and then rolls over and crosses the whatever, and you just put, okay, that is exactly where I make the decision. And then you make all your decisions, and then you turn the price back on and you see where it actually took effect. And and if you can live with that, you don't need the price bar at all.
Well,
That's a stretch. That's a very interesting, it's a very interesting psychological experiment, because what it does is turns off all the noise of price. If your decisions are geared towards the movement of the RL10, for example, compared to the PSAR or the Dragon or a 3-period moving average of itself, all the price is doing is generating noise and cognitive dissonance. I like and that's why I like on swing trading, especially because a 2 ATR initial stop is so far outside any individual price bar, it doesn't even matter. And I like swing trading just with the 4 regression lines and a ATR box.
Well, it would be an interesting exercise to do. With the 3 minutes, right now I'm trying trading with some tiered stops based on my result and no loose unit +2 and all that. So I don't know if I could do that without the price bar. So I'm still trying.
Well, what you'll do is when you need to take a break and you just need to stretch your brain a little bit, just try it as a paper trading, forward trading. It's a warm-up exercise. And what it'll do is it'll tell you something really important about the quality of the rules. Like if they're positive expectancy, at some point you just say, what I want is positive expectancy. And however I get it, if it's a little sloppy with some of the price bars, but I got a robust rule set, dude, that's a really important, mature decision to make. But that's why I put I make the price bars light gray, because I still secretly like to, you know what I mean? But if you have a rule that says, if the price hits the PSAR, I'm out, you don't even need to see the price bar, because if the price hits PSAR, it triggers you out. You say, okay, fine. It hit it and I didn't even know it. I got surprised into the exit. I didn't have time to overrule my rule. That ain't all bad. Think about that in surgery as a 100% foolproof limit box that guided where the laser tool was making cuts. And it wouldn't let the laser head out of that ironclad box. As long as it's doing that, you don't need to see every little, that kind of shit.
So you mean you'd be moving up your stop with the PSAR without looking at that price as you made? You just be moving. You don't even need to see the price. Oh, the way you get out of it sooner if the R10 rolled over and moved some distance away, but price didn't hit the PSAR yet. You're just waiting for an orderly exit based on the RL10 rule. But if price started collapsing so much faster than the RL10 could react, well, you have a rule that says price hits the PSAR, I'm out, done. Now I get surprised. I'm at the opera, somebody hands me a slip of paper and says, oh, you exited because price hit the PSAR. Oh, okay, well done. In case of emergency, break glass. Done, I'm out and I didn't have to think about it. The only one I want to think about is, so just give that a thought. It's actually a pretty fun thought experiment to really, it makes you think hard about what information do I need to have on the screen in order to make the decision to move my stop, exit the position, whatever it may be. Well, once I kind of get the processes satisfactory over the next couple of weeks, that's where all the work is going to come in. There's so many different ways you can exit, and I've got all those swirling around. So I need to get clear on what actually is going to give me positive expectancy.
I think you're going to find you end up going towards, I need one routine exit and one emergency exit. I believe that price hitting the PSAR is the emergency exit. I can live with that. And I believe when the RL10 gets to a peak and rolls over, I think the skin of the dragon is fine. Like if the RL10 peaked and then rolled over and went negative and price was already below the skin of the dragon, exit.
So you could exit at the dragon, you could do a 1, 2, 3, which may be about the same area anyway.
Yeah,
Like
at that point, you're fighting over crumbs. And it's adding cognitive complexity to you. So I think conceptually, I've never said it that way before until tonight, but I believe now that what we want is one routine exit and one emergency exit. If we have, and then pick the variation on the theme. But I think what I worry about with the routine rule-based exit is the emergency happened and I gave back too much. And what I worry about if I only had the emergency rule exit, then I'm always thinking about, is it an emergency? Is it an emergency? When's the emergency? And then that makes me so nervous that I burn up all my cognitive energy and I end up getting out. When if I just had a routine rule exit, hey, whatever it is, RL10 slope is positive, the PSAR. Just keep going.
Well, does that leave a gap sort of in the middle where you had a nice move, the RL10's really run up, now it's coming back, now I'm doing the skin of the dragon, I want to get that. And then you have the ones where, okay, I had an emergency, it goes to the PSAR, but then you've got the in-betweens where, okay, I got a 0.6 SAR. That's where
if I'm thinking about it with my head, it's like the emergency is I got an unexpected benefit. I got the unexpected win. It's not extraordinary yet, but goddamn, it's better than average.
Yeah.
That's what the no lose plus dinner for two actually is it accelerates the stop ahead of the PSAR and it just locks in whatever you want to keep. Done. I just say, look, I had an unexpected good fortune. I had beginner's luck. So let's not spit at a gift horse. Let me just let me just stake an entry in there, done. And then when the PSAR catches up to it, revert back to the PSAR. Done.
I'm tracking when I move my stop to no lose dinner plus 2 to try and figure out if it's helping me or hurting me. And it's one of the things I'm thinking that is, point I do that.
Yeah. I'm thinking that you're, on the ones you've showed so far, you're noticing that is, your current rule is almost premature. That you're cutting off some good trades before they become good. It ended up being a good.
Some more data on that, but that's what it seems like so far.
Yeah, my thought is that at some point, until it gets to be an average win, it's nothing anyway. It's a fraction.
Okay.
Once it gets above average, that's where I think I should be at no lose. The standard for 2.
Okay.
And then when I get above average plus 1, now I have a really good trade. Maybe it needs to go to the average win or something like that. So that's what that intermediate adjustment looks like. That to me is the hardest decision of all.
Yeah.
And if that's the hardest decision I ever have to make, I can live with that. What I like about the no lose plus dinner for 2 is I'm making some money on this trade. It's not going to ruin my portfolio. And I've had all kinds of trades where, hey, I missed the great big move because I was monkeying around. Okay, I can live with that. If that's my worst day at work, I know what a bad day at work looks like. And that ain't no bad. So, all right. Is that everybody? I think we got everybody. A lot of good work tonight. So this was much more you than me. It was still more me than I wanted, but there were reasons for it. I feel like we had some we still had some foundational ideas. I'm always looking, if I sense that there's something in the answer I'm going to give that pertains to more than one person, that's where I'll tend to be a little more verbal or verbose. And as we get further and further along, it'll probably be less and less of that. But there we are. So good work tonight, guys. And don't hesitate to follow up with me like during the week if there was something, that can't wait or whatever. It's okay to be stuck a little bit. Don't stay stuck too long. The individual follow-ups we can still do that. Okay, that's everything I got. I need to hustle up, and everybody else is probably outside the room wondering what the F we're doing. But that's all right. They could have been here. So appreciate you.
Thank
Take
you.
good care.
You too.
Cheers.
See ya.
Thank you, sir. Thank you.